So in this video, we're going to talk about a kind of an advanced concept of something called a compensator, and that's generally used with synthetics. And here's the way it works. You know, when a stock is running up, if you were in the money or at the money, and your delta is kind of low-ish, that means that you're going to be losing dollar for dollar as it goes higher than your strike, but you're not going to be making that up on the base position. See, if you had a 90 delta, 90% of the time you're going to make money, and 10% of the time, roughly, you're going to be, losing a little bit of money on the price over the strike when it runs up. And so you don't want to get stuck in that position because it's really annoying. You're actually making money, but you're not making money because your base position is not going up as much as it should. And so we use this thing called the compensator. And I dot the compensator around our program quite a bit because, we start out fairly conservatively by being in the money. Well, that works really well when the stock is going down. We tell you that we eventually want you to move to closer to the money, maybe even at the money, because you'll make your most amount of money at the top of that bell curve. And so that is where you want to move. But there's a time where you've gone through a protracted downslide in a stock, and your delta has eroded, if you have synthetics, on your base. And so since your delta is eroded on your base, now you're stuck if you haven't rolled down to a deeper or farther out or both call on your base, you're stuck with a lower delta. And so when it goes back up, you don't get to make that money on the way back up because you're constantly having to use up working capital to chase the stock, and you're getting hammered on the way back up. I mean, it's weird, but we will make our most money out of the money on an upswing. But if we're not out of the money, then we're going to have a little bit of trouble. So let me show you how you solve that. So I went through this protracted decline in Tesla recently, and I was just out of the money, basically getting $3 a week out of the money in juice. And as the stock went down, I was getting my $3, and it went down for several weeks. Then it bottomed, and now it's making a bullish kind of pattern, right? So the market's green, it's a little more bullish. The stock is 821 positive. So I want to be out of the money, and I'll tell you why. So look at the screen here. The stock right now, or the stock when I did this trade, I'll say, was just around 206 and some change. It moves around a lot. Doesn't matter so much. So I had, because I had been rolling some down, but I had basically 200 of the 180 calls, okay, with an 80 delta. Those had declined from a 90 delta. And I still hadn't been able to roll down my 220. So I was out of the money on my base on 50 contracts. You could see that because I have a 56 delta. Now, we're a few months out. That's why it's 56 delta and not in the 40s. But still, delta's pretty low, you've got to admit. So when you blend those together, you multiply the 220, the 50 calls times the 56 delta, and the 200 calls times the 80 delta, and you blend those together, you come up with a weighted delta of around 75. So I had a 75 delta. What does that tell me? Well, I better not, if I believe Tesla is going a little higher, and I don't know if it is or not, I just have to believe that the probabilities are in the favor of it going higher. I have to believe that it's going to go up. And so instead of selling all of my calls, I chose to sell 75% of the calls because I believe it's going to go higher. So I use the 75 delta as my factor. So if I use the 250 calls times 0.75, I get about 188 calls. So I'm going to sell 188 calls at the 215 strike, and I'm going to pick up $3 and a penny in juice. Okay. Remember, this is a bullish strategy. We want that stock to go up over our strike price. Let me show you how the math works out. So we've got the 188 contracts times the $3 in juice, and that's about $56,000, 588. That's our money. Nobody could take that from us. That's our juice. So, we always get the juice 100% of the time. So we get to keep that. Now, at expiration, what happened on this trade was the stock actually went above the 215, which is great for the uncovered ones, and it's not so great for the covered ones because I got $3, but I had to pay more to get out of it. But here's the way I look at it, right? Because I used the compensator, when the stock was over 215, in other words, it closed at 221, I saw my 50 contracts were at $15, right? They went up by $15 times 0.56 because the gain over 221 from 206 was $15. So I got $15 in gain 50 contracts times the 0.56 delta, that went up 42,000. 200 contracts at 15 at the 0.8 delta was 240,000 increase. Right? You see how I didn't get it all. I only got 80% of it. And then I lost, quote unquote, in working capital because it was over the strike, $6, 215 minus, or 221 minus 215 is $6. So I had 188 contracts, but it cost me $6 because it was above the strike price of 215. And there was 100% delta on those when they expired because it was in the money when it expired. And I lost 112,800. I use the word lost in quotes because you didn't lose it. It's just working capital that it cost you. But if you net it all out, I got 56,588. I gained 42,000 on the 50 contracts. I gained 240,000 on the 200 contracts. But I subtracted 112,800 because it was over the strike price. When you net it all out, it was a good week. I ended up gaining 225,788. I tried to make the math slow, but I know I threw around a bunch of numbers, so you may want to watch this again. But the concept is, when you use the compensator, you lose less on the roll-up if it goes above your strike. And eventually, you'll be able to build the muscle to be moving into the direction when you think a stock is going higher, not because you think it's going higher, but because the probabilities of the right spot on the chart, the green market, the 821 positive are all in your favor. Now you can start to play a little bit around with being out of the money. And if you have a low delta on your base, you don't want to be dollar for, share for share, contract for contract at the money or even in the money. You want to try to be a little out of the money. Now, sometimes we do, I'll sell at the money half and a little bit out of the money half, things like that. But in this case, I use the percentage compensator to say, okay, I have a weighted delta of 75. So therefore, I'm not going to cover all of my shares. I'm just going to cover 75% of them. And then I'm going to leave 25 because I think the stock is going up. And I happen to be right this week. I'm not always right, for sure, as you know. And that's the way that we use the probability. So let's sum up what we just did. So here are the takeaways. Number one, you always get the juice. You know that by now, right? You always get the juice. That's the only external thing that's always coming into your account. The rest is all market value. Number two, when you're out of the money, you are totally hanging by the juice. You've got no downside protection. That in the money amount protects you, but out of the money, you got no in the money amount. You're only getting the juice in case the stock goes down, and it's going to go down a lot of times. This is a probability system, so you're trying to get things in your favor, but we don't know. When the stock does run up, like it did in this example, you chew up less working capital. That's kind of a good thing. Plus, you get the gain when it goes over your strike. But there are a couple of downsides. First of all, we would have made more money selling at the money for the last few weeks as it went down. We only got $3 out of the money. If we'd have been at the money or even in the money, we would have protected the account. Actually, we would have made more selling at the money, because if we're getting $3 out of the money, we're going to get more selling at the money. I know you know that by now. And then the other side is we would have lost less selling in the money for the last few weeks rather than being out. So we were wrong on the way down. I was wrong, I'll admit it. But I could play the probabilities. I would have made more money by being at the money. I just didn't want it to be bouncing up over me. So I was out of the money on the way down, picking up my $3 a week. That was my goal. And I did that for about 8 weeks. And then it bottomed, and now it's going back up. And that's why I use this compensator strategy. So those are the takeaways. And I hope that helps. It's a good strategy to use, but you got to kind of know what you're doing when you're in synthetics anyway, because it has all these little nuances. This is a pretty cool way on a run up to be able to protect your position, maybe make a little bit of more money as the probabilities stack in your favor. See you next time. Hi, Mark Yegge here, wealth architect and author of this book on my covered call investing system called the Cash Flow Machine. Listen, what you just saw is just one part of creating reliable income of 2 to 4% a month from the stock market. But if it were that easy, then everyone would do it, right? If you want to learn how I create investment income the right way, then you need to learn and have a system with rules and what-if strategies so that you can learn what I do when the market goes against me, what I do when the stock goes against me, how to adjust my trade so that it's always in a winning position, how much to risk, how to build a multi-million-dollar portfolio that creates income of $10,000, $20,000,
or $30,000 a month in semi-passive income. And best of all, the whole cash flow machine system takes less than an hour a week to implement. Just go to cashflowmachine.io to learn more, or click this link for more videos, masterclasses, and free resources. See you there.